Hey, what's up guys, it's Jonathan here, back with another public stock portfolio update. So as usual, do a recap of some of the moves that we made in the portfolio. Then we'll do a recap of how the portfolio is doing overall. And then we'll talk about some things I'm currently seeing in the market right now. So if this video provides any value, please consider hitting the like and subscribe button. They both greatly help out the channel, help push this video out to as many people as possible. So let's get right into it. So as usual, I deposited the $10 that we deposit into this account every week. But something that I did different this week that I haven't done in any other week is that I didn't buy anything. I'll go into detail why I didn't buy anything this week and give you guys some depth on that decision. So now let's go into my iPad and let's do a quick recap of how the portfolio is doing overall. So currently the portfolio sits at $176.55. And so far we're down almost 21% or about $46. So the first position we have is Tesla. Our Tesla position is up currently 4%. And makes up about 18% of the portfolio. Tesla has been one of those companies that have actually held up pretty well throughout most of the volatility that we've had in the markets. So the next position we have here is Enphase, and Enphase has taken a pretty significant hit, not only in our portfolio, but this overall. It's currently down about 14%. It makes up about 17.5% of the portfolio. Right now, I believe you're paying summer of 2021 prices for Enphase. It's really not a bad time to add on to this position. The one thing I will say is that you have to be careful because there is a lot of news about California tightening its regulations on solar panels. I believe they want to charge a tax for every solar panel you have on your home or something like that, which in my opinion, I think is absolutely stupid because on every new construction home in California, they also demand that you have solar panels on your home. So pretty much you have to pay this tax if you're buying a new home. Real estate in California is a whole rabbit hole that we don't need to go to in this video. So let's just move on. Next position we have here is Hood, or the Robinhood, and it's currently down about 44%. Makes up about 13% of the portfolio. Yeah, it's actually recovered a little bit from its all-time lows at $11, but it's still down pretty significantly when compared to where it's been over the past couple months. It's definitely a company I still think is undervalued. Given the earnings that we got from Hood, our PayPal, I don't think fintechs are really going to do that well this earnings season, so that's something to keep in mind. Next position we have here is Google. Google, I'm actually very upset with Google, and I'll get into that reason later in this video. And as a precursor, that's not the reason why I'm upset with Google. It currently makes up about 11% of the portfolio. They did announce earnings recently, and they did some BS that I'm not very happy about. So we'll get into that. Next position we have here is Etsy. Our Etsy position is currently down 30%. It makes up a little under 10% of the portfolio. And Etsy has taken a beating as well during this sell-off that we've had recently, but I still think overall they're a good company. The next position we have here is Nvidia. Our Nvidia position is down about 8% right now. I don't believe Nvidia has reported earnings yet, but that is an earnings I do want to look into. So that'll be interesting. I actually wonder what the price of it's now. $243, okay. Still a little up there, but it's not too bad. It currently makes up about 7% of the portfolio. The next position we have here is Amazon. Our Amazon position is down 8%. Amazon, along with a lot of the mega cap stocks, have kind of been on a roller coaster ride recently, which is like absolutely insane. We're talking about some of the biggest companies in the world moving up and down like 10% like that. Absolutely wild. Currently makes up a little over 3.5% of the portfolio. Next position we have here is Cloudflare. Cloudflare position is down almost 16% and makes up about 3% of the portfolio. Like I say in some of these other portfolio update videos, software is going to take a beating during this tightening cycle that we're going through with the Fed. It is something that could definitely get hurt even more as time goes on. So the next position we have is Matterport, and our Matterport position is down 47%, and it makes up about 2.5% of the portfolio. I'm curious to know what the price of Matterport is. It's at $8. Which I believe in the last portfolio update video, I talked about how Matterport was a SPAC, so its par value is $10. So you're paying less than even what the PIPE investors paid if you bought Matterport today. Which is crazy because unlike a lot of the other SPACs that you see out in the market, this was actually a SPAC that was properly valued. But anyways, let's get to the next position here, which is Trade Desk. Our Trade Desk position is down 13%. And that actually reminds me that I do need to talk about advertising, because there has been something that has changed with advertising. But we'll get into that later. Currently, it makes up about 2.5% of the portfolio. Then the next position we have here is
SoFi.
SoFi is down 14%. Like I said about Robinhood, I feel like SoFi as well, being a member of that fintech space, will also be taking some shellackings in the near future. It currently makes up a little under 2% of the portfolio. Next position we have here is Palantir, and our Palantir position is down almost 43%. Again, it's in the same basket as Cloudflare, so it's gonna move almost in the same way as well. Next position we have here is Redfin, and our Redfin position is down 42%. Like I've said before, I think that Redfin is going to be in a lot more pain this year, just given the increase in interest rate environment that we're in. The major reason why I didn't buy this week was mostly due to what's currently going on with inflation, the supply chain issues. So to give you guys some background on this, during the FOMC meeting in January, Jerome Powell stated that the primary driver of inflation is the supply chain issues we're currently seeing in the markets. And in that meeting as well, Jay Powell also stated that the Fed will do anything in its power to stabilize prices and control and bring down inflation. That their primary tool to do this will be by increasing the federal funds rate. So if inflation doesn't subside naturally, the Fed will be more aggressive to tighten the money supply. With that in mind, let's talk about earnings this week. Given what the Fed stated at the FOMC meeting, it would benefit us if we're reading through earnings statements to see supply chains start to ease. During Apple's earnings conference call about 2 Thursdays ago, Apple stated that their supply chains are starting to get better but are still a significant issue to the company. And they expect to have their best Q2 that they've ever had in the history of the company. For Apple, their fiscal year starts on October 1st. They're a quarter ahead of what's normally considered Q1 2022. Even though a big company like Apple is starting to say that their supply chains are starting to ease, it's important to remember that Apple is one of the biggest companies in the world. They have a lot of pricing power when it comes to supplies. So it's not really the best representation of the entire market to look at when we look at Apple. But unfortunately, the stock market looked at it as, oh, supply chain problems are over, we're going to the moon. And that was not the case at all, as we saw throughout this past week. Some of the other larger companies on the stock market that reported earnings this past week, Facebook being one of them, they gave really bad guidance for next quarter. This was some of the reason why we saw their stock sell off almost 25% after they came out with earnings. In their guide for next quarter, they say that they'll probably miss year-over-year revenue growth from the market's projected 19% to a mere 8%. And they blame this on two major things. Firstly is Apple's iOS security update that allows Apple product users to determine what information you could track from their activity on their phone. But more importantly, they did talk about how advertisers have had their ad budgets slashed due to inflation and supply chain problems. And to me, this gives an overall bad omen to the whole advertisement thesis that I had at the beginning of the year. Because for a company to go out and say that they're going to spend money on advertising, they need to have the supply to be able to deploy to the customers that they're advertising to. So if they don't have any supply, then there's really no point in advertising. Even though somehow Google dodged this question throughout their entire earnings, I went through their entire earnings transcript and not once was anything talked about inflation or supply chains. This is an issue for entire ad space. So Facebook, Google, Trade Desk is definitely going to put downwards pressure on their stock if we start to see the supply chain get worse and worse over time. Google did run after they reported earnings, but that was mostly due to the fact that they announced a 20-to-1 stock split. And a lot of times the stock split starts to become very momentum driven. So Google, you have to be careful with because we may start to see a lot of volatility in that stock just due to that one announcement that they made. Then PayPal also reported this week, and like Facebook, they gave really bad guidance as well. They cut their projected growth rate in half, and they again cited supply chain issues, inflation, and the reduction of government-provided stimulus infecting their merchants and user volumes. The Starbucks as well, in their earnings report, talked how staffing shortages, not only internally, but also with third-party vendors, has caused their supply chain issues to become even worse over this past quarter. And they also discussed how wage inflation is causing high turnover within their company, and is leading to unprecedented training costs. And in their earnings call, they did state that anticipated supply chain driven inflation that they're seeing, they plan to continue to see until the foreseeable future. And this in turn will cause the company to have to raise prices. And the list of companies that have talked about this kind of stuff goes on and on. So for me, there's two takeaways from this. So given what we saw from earnings, which mind you that the Federal Reserve is looking at these earnings as well, not only just the hedge funds and retail investors, and given what I stated early on about the Fed and what they said at the FOMC meeting, where they said that the primary driver of inflation is supply chain issues. And something else as well is that in the FOMC meeting, Jerome Powell was asked point blank, does he care to slow down the tapering to protect asset values? And he point blank said, no, he only cares about the real economy, which is stable pricing and maximum employment. Well, of course we have maximum employment. So maximum employment is not a worry of the Fed anymore. Right now, the worry of the Fed mostly has to deal with stable prices. And for them to have stable prices, they need to control inflation. Even though the Federal Reserve isn't out there to maliciously attack the stock market, even though they have the dual mandate, their number one mandate is to protect the sanity of the US dollar. And if that means that they have to drag us through a recession to do it, let me promise you, they will do it. So even though we are seeing all these kind of false rallies here and there, it's very important for you to understand that, like I said in last week's portfolio update, the Fed is going to run the show when it comes to the stock market over the next year or two. And their actions and what they're saying and what they're thinking is going to become very important to determine when we'll finally see a stop to all the bleeding. And because of that, I personally am not buying any stocks right now. So I decided not to go the Meet Kevin way of, let me go sell everything, all my stocks. But I'm also not going the way buying this dip. I don't think there's necessarily a problem with the way either one of these guys are playing the market right now. And what I actually plan on doing is that right now I'm just going to hoard cash. But one thing I will say is that if you have a smaller portfolio, I can't give you financial advice, but you may want to consider just dollar cost averaging into a market like this. It's probably the least riskiest way to invest. At that point, it's very important that you start to build a foundation for your portfolio. But for someone like me who has multiples of my income in the market, I personally am okay with just sitting this out and waiting until I see a more definite bottom. Because for me, right now, I think I'm about 20% in cash. So even if the market was to run for the next 2 weeks and I missed out on it, it wouldn't have that big of an effect on me. I still am mostly in the market. I still mostly am exposed. So it is a little risky. And I will say that if you want the least riskiest way, it's probably better that you just dollar cost average. But for me, I'm kind of deciding to hoard my cash and kind of wait until I start to see this inflation and supply chain issues start to reach an inflection point and start to inflect down. And then the second takeaway from this as well is that I think that the advertisement thesis, the advertising companies will do well in this year, I think that is pretty much all but dead at this point. Most of these supply chain issues, we're probably not going to see them clear up until early next year at the best. I still like Google, I still like Trade Desk, so I'll probably still hold them long term. I'm not expecting them to really outperform this year, so I'll just have to be patient and kind of diamond hand those positions. And when it comes to the future portfolio updates, I'll probably just give a recap of how the portfolio is doing, and then we'll have a discussion like this where we talk about kind of what I'm seeing in the market and what my thoughts are. So thank you guys so much for watching. If this video provided you value, please consider hitting the like and subscribe button. They both greatly help out the channel, help push this video out to as many people as possible. Also, check my analytics, and 80% of you guys are not subscribed to the channel. If you made it this far in this video, you'll probably like the other videos I post as well. Consider hitting that subscribe button and notification bell so you get notified anytime I post a new video. Also, let me know what you guys think about the market right now in the comment section down below. I would love to hear from you guys. Also, check me out on all my other socials. I try to post there as often as possible. I post a lot of short videos on those, so if you're interested, check it out. And thank you so much, and I'll see you guys in the next video.